Welcome to our webinar tonight, our fireside chat between Paul Atkinson and Martin Gilbert, neither of whom need any introduction from myself. And I'm just absolutely delighted that both have given up their time again, well, Paul again, for this fireside chat this evening. I'm going to hand over to Paul. Paul, you're still on mute.
Thanks, Jude. That was an amateur mistake there. Welcome on board this evening, everybody. And we're now finally getting to a stage where lockdown starting like it might unlock, and we're starting to relax a bit. And we can have a relaxed conversation this afternoon with Martin Gilbert. Thanks, Martin, for joining us. We've got quite a lot of questions, but the first thing I want to start off by saying is, everyone talks about the new norm coming out of lockdown and COVID. What's the new norm going to be like for Martin Gilbert, Martin?
Yeah, no, it's. I mean, I think we have seen the ability to work remotely advance 5 years and 10 weeks. So we really have seen technology move on, and I think that big companies have managed to adapt to working from home. And when I take HSBC as an example. I was speaking to the CEO, and they acquired 225,000 laptops to enable their staff to move to work from home. So you can see the sheer logistics involved in trying to buy 225,000 laptops. But as far as I'm concerned, yeah, the new norm. I mean, I spent a long time in Aberdeen, the longest I've been in Aberdeen, for about 30 years, because for the last 30 years I've been involved in trying to build Aberdeen into a global business with clients in 80 countries and 30 offices around the world. So it's really nice to be back. It's also great not to have to get on a plane, and as long as you've done all the work over which we all had over the previous 10, 20 years, you know enough people that you can now jump onto a call with them. And as I say, the technology is so good now compared to the old videos with the VCs we used to have. So no, it's been great. I've thoroughly enjoyed it. It's been nice. It's been nice being in Scotland for such a long period of time.
Yeah, actually, I think Scotland's been quite a good place to be during the lockdown. We've got plenty of decent senior around and stuff to do. But I think, as you say, Martin, Zoom and Teams and all the rest of these kind of video conferencing tools have worked amazingly well, and allow people to largely continue doing business, which has been great. You talked about 10, 20 years. One of your team was explaining to me earlier on that he'd been working with you. You acquired 60 companies, I think he said, over 30 years. Of those 60 M&A acquisitions, what was your favorite one and why?
Gosh, yeah, I mean, I would say two of the favorites, because well, no, maybe three. The first one is always good, and for it to have turned out so well, because from it we built our Asian business, and that was a business we bought, and with it came Hugh Young, who headed Asia for us, and he was instrumental in growing our business. The second one would be probably, we bought a company when we were in deep difficulty called Edinburgh Fund Managers, and that was the most difficult transaction. And we bought it and sold half the business for the same price as we paid for the whole business that same day. So it was a really spectacular deal in the most incredible circumstances. And then I suppose my favorite was the one that really propelled us into the big league, which is to buy one of the big four in the UK, called Morgan Grenfell Asset Management in 2005, and we saw off about another 20 competitors, and we just kept in, and it was fantastic. So those would be the, and that tripled us in size. I mean, it was an amazing transaction, and as I say, it took us into the big league globally. So yeah, I would say of those three, I would go with Deutsche probably. The old Morgan Grenfell, which was
yeah. So after all massive successes, and obviously most recently joining up Aberdeen and Standard, and you're now stepping out to do more of a kind of portfolio thing. Martin, is my understanding. Can you tell me a bit about your kind of rationale and what you want to do and where you want to take that?
Yeah, I also wanted to go before I was asked, because most CEOs outstay their welcome, and it was nice to go when people still wanted me to stay. And I'd done 36 years as the CEO, and I was the longest serving CEO in the FTSE 100, all of that sort of stuff. So I knew the time was right to go. And also the business was getting more and more difficult, and I wanted to get back to doing what I like the best, which is growing businesses rather than running steady state businesses. And I'd like to do one more. I'd like to do one more job in asset management at the small end, though, rather than the big end, because it's an industry I do feel passionately about. And then I've always done non-execs as well. I was one of the founding directors of First Group, and we built that into a massive business. And I'm on the board of Glencore, which is fascinating, being in the global mining business. Chairman of Revolut, which is again fascinating. So yeah, I'm mixing. I'm hoping to mix them. But I don't want to go back in and run another asset management business. I'd quite like to be involved, though, and more at the helping them build the business rather than running it on a day-to-day basis.
Well, maybe we can talk about private equity after this. There's a small asset manager based out of Edinburgh, but I don't want to set any rumours running. But yeah, I mean, it's a fantastic career in so many different ways and so many different business lines. I mean, what do you think the impact of the changes, digitization, home remote working and so on, are going to be for asset management specifically? And what do you think the impact's going to be on investment of these kind of moves in the market?
It depends what industry you're in, what effect it's going to have. So asset management, it worked pretty well for the asset managers. I mean, they can work at home and can work pretty well, because a lot of them are doing day-to-day research, looking at companies, and in fact, there's an argument they might be better off working at home. The dealers probably need to be probably more in the office, those that are executing trades and just even from controls, etc. But working from home is, it depends who you are. I mean, if you've got a nice big house in the country, working from home is great and you got good internet. But if you're flat sharing in London and you're sitting on your bed in a flat share with your laptop fighting for the internet signal, it's not been so great. So certainly at Revolut, we're seeing a lot of people wanting to come back, especially in that age group. And also work can be a large part of their social life as well. So it's certainly, it depends. It depends what type of person you are, whether you want to be working remotely or not. And certain businesses lend themselves to working remotely, but I still think you need, as a team, to get together at least once a week or twice a week, just to bounce ideas off each other. And then perhaps in London, where a lot of people are commuting, expensive commutes, etc., maybe working from home a couple of days a week is going to really, really be beneficial for a lot of people, and for business as well, because we've seen productivity doing pretty well working from home.
Yeah, I'd absolutely agree with that, and I'd also agree with the fact that, you know, working from home is not perfect for everybody. If you've got a small place, if you've got kids running around or whatever, it's not necessarily a great thing, and you have to cope with it, and we've had to cope with it. It'd be interesting, as you were saying slightly on before we came onto the call, Martin, you were talking about Switzerland, how actually they're actually having to ask some people to go back to the office.
Yeah,
and I kind of wonder. I'm interested in your thoughts. I kind of wonder how many people have got used to working from home. It's now a bit of a habit, and getting them back to the office might be a bit of a problem.
Yeah, well, it's going to be interesting. I mean, as far as we're concerned, we're back. Really, we didn't furlough anyone in the asset management business, or lay anyone off, or any of those sort of things. So certainly, I was in Zurich yesterday working, and it was completely back to normal. I then flew in to Heathrow, where I had to queue for about 45 minutes because of this crazy idea we've got that everyone has to, everyone apart from a huge number of exemptions, of course, has to self-isolate. But certainly Switzerland are telling the companies to make people get back to work, because they want to get back to normality now. So and Switzerland, as you know, is incredibly well organized. So it will happen. It will happen there.
Yeah, that's kind of interesting. I mean, I think my personal opinion is that actually business might actually bounce back quicker than some people might think. What do you think, Martin?
I think business probably will do okay, but I'm worried about the number of people that business are going to lay off. That's what I'm particularly concerned about. So the companies will do fine, I think, especially the big companies. But I think there's going to be a lot more people, especially in the hospitality business, and these sort of businesses are going to be laid off. And I think that's where the big problems occur. But a lot of our companies are big global companies. Will do pretty well. We'll do okay, which is why we're seeing the stock market probably doing better than most people think.
I mean, you've obviously had an amazing career over the last 30 plus years, Martin. If you could pick out something, or maybe a couple of things, what are the most memorable things over the last period, over your period of your career? What are the things that really stand out for you?
I think, look, I'm never a great believer that you're never as good as people say you are, and you're not as bad as people say you are. So, I've been incredibly lucky in having a team that worked with me for 30 odd years. So we were a very, very tight-knit group of about five or six people who worked as a team for 30 years. So that was what gave us the success we had. And the great thing was that everyone managed to develop from being a very small company turning over less than £1 million to a company turning over £1 billion. So I think it just shows that people can go the whole journey. But as to the most memorable, I think it's funny, and I was just thinking earlier today, when we started, $1 billion was a significant amount of money. Now we just throw around billion. We throw around the number that we've got 600 billion under management. But getting to the first billion was the most memorable.
Yeah, it was a hard bit.
Yeah. Good sort of moment. And in those days, it took us 10 years to get to $1 billion, and another 10 to get to 25. But I suppose the thing I'd be proudest, not proudest is the wrong word, but is managing to rescue the business when we ran into regulatory issues, because it's easy to be the CEO when things are doing well, and as I say, and everyone tells you how good you are, but you've got to keep reminding yourself you're not as good as they say you are. And then when we were going through the tough times, everyone says you're useless and should be fired. And I was very, very fortunate to survive. And I had a supportive board, and it was interesting. The most supportive board member was Sir Malcolm Rifkind, who was an MP at the time, and you'd have thought politicians normally distance themselves from disaster, but he was absolutely amazing and was incredibly supportive, and really was great. So I suppose, you know, when you live through 2.5 years of being under investigation by regulators and all of this sort of stuff, and you come out the other side, I think it makes you a better company. And most CEOs don't survive a fall of 75-80% in the share price, but I survived a fall of 95%. So it was wow. It was really, really remarkable to be allowed to sort out the mess that you inevitably have to take responsibility for if you're the CEO. So. But those two things, getting to $1 billion and sorting out the mess, would be the two things that stick most in my memory.
Yeah, that's fantastic. But the backdrop that you mentioned was the team and also the supporting cast. Malcolm Rifkind being one of the supporting cast, I guess. What advice would you give to people on this call about building a great team? Is there a few things that stand out that you would recommend that they thought about?
Yeah, I think the other thing is building a great culture. And the way we did it was just by only recruiting graduates. We never ever, and if I use the analogy of a football team, all of our guys came through the academy rather than, all our top fund managers came through the academy rather than going out and buying expensive players. So it was a bit like that great Manchester United team. But more interestingly, like the great Barcelona football team that beat Manchester United in one of the European Cup finals, because I'm sure those of you who know about football know they have this famous building called the Farmhouse, and it's where all of the youngsters train. And the team that beat Manchester United, 9 of them had come through the academy. So rather than, and in our world of asset management, you can go out and buy talent, you can go and recruit a great fund manager. We never did that. We only ever took on graduates and built them into teams. And again, in asset management, you can manage investments in 2 different ways. You can manage it with the star fund manager, a la the Neil Woodford model, or you can do it in teams. And we've always been a team-based approach, believing that team decisions are better. It slows down decision-making to a certain extent, but we believe it's better, and you don't get the disasters like you do with the Neil Woodfords. And Neil Woodford, by the way, was a hugely talented fund manager, and if he'd stuck to what he was good at, which was managing large cap income funds rather than going into early stage medical technology, he'd have still been he would have been world class. And then you get the Terry Smiths of this world, still phenomenal fund manager. So you can have either approach, but we were always the team-based approach. Teams we feel work better than individuals.
Yeah, I've got to agree completely. I mean, certainly the way Par Equity makes its decisions is based on team. You know, it's a team effort in terms of deciding which companies we back or don't back. And yeah, so I'm entirely in agreement with that. And if you look back over your career, Martin, is there anything you would do differently when you look back?
Yeah, clearly you wouldn't get yourself into the mess as you did. You would try and not make the same mistakes you made. Obviously, but to a certain extent, it's those mistakes that make you as well. So you can always think, God, I wish I hadn't done that. But if you hadn't done it, you'd have just made another mistake, I suspect. So those. But I wouldn't sort of change anything on the way we did it, or anything like that. We had a model that was very simple, which was we would buy and we would acquire, as well as grow organically, and put it in and integrate it. We were a fully integrated model. So we would buy businesses and integrate them into with one brand, one risk team, one, or else you can go what we call the multi-boutique model, which is you leave them as standalone equity, as standalone operations, and do a bit of their back office for them, but allow them to do what they want, basically. But that wasn't our style. We integrated and took out costs, basically.
Yeah, it sounds like you had a very kind of focused strategy to take that forward, and obviously ultimately resulted in a brilliant success story. So what have the next few years got in store for you, Martin? What's the grand dream for the next 5 to 10 years?
I'd like to do something else in asset management, but as I say, at the small end. I mean, there are three big trends in asset management, which we're sort of fighting as a big long only, what we call a big long only asset management, and those are we're seeing this massive move from active to passive. So people are buying passive, i.e. index funds. We're seeing fee compression, but the most interesting one we're seeing, which I think if you're small and nimble and sort of thinking of doing something again, is this business of people selling public markets, i.e. public equities and public bonds, and buying what we call private markets. And private markets can range from property to unquoted bonds, private equity. So the world's big investment institutions who are our client base and who I spend my time speaking to are moving a percentage of their assets, probably say 5% of the world's assets are moving from public markets to private markets. So it's a huge opportunity for people in Scotland, I think, to take advantage of that massive move, with this massive liquidity now looking for private markets. So it can be anything from student housing to warehouses. We do very well in our warehouse fund because of this move to online. Those sort of things, aircraft leases, there's just everything. So private equity, early stage private equity, there's more money, there's a lot of money looking for that. So that's the area of opportunity. And if we think, as I say, the common theme is 15 to 20% moving to 20. But if I go to Canada, and we manage money for a lot of the big Canadians, they're already at 50%. So hence the reason they might own water companies in the UK, airports, all of these type of things. So it's a huge opportunity in what I would term private markets at the moment, and that's where I would, on the other side, that's where I'd be looking to tap into that massive liquidity that's out there.
Yeah, interesting. I've had some dealings with the Canadians in terms of wind farm assets, because we do some forestry investment. So yeah, I can absolutely see that and see that kind of movement. That's really interesting. I was just talking about some of the things you've taken on. OGTC is an interesting role for you to take on, Martin. What kind of prompted you to look at that, and what are your plans for it?
Well, I think, I thought to myself, I should, Aberdeen has been incredibly lucky for us as a city. We started there. All my colleagues, the 4 or 5 guys I was speaking about, all still live in Aberdeen. We all still have houses there, and it was really just a small I thought if I can do anything at all to help the city when going to be going through a very difficult time, just because of these headwinds that are hitting it with the lack of demand for oil at the moment, the price, all of these sort of things, it's going to be a tough few years for Aberdeen. So they asked if I would be prepared to help, and I said yes. No, I would be delighted. But people had to understand that as a fund manager, I know a little about a lot of things, not a lot about a little. So asset managers like myself tend to be generalists rather than specialists in one sort of topic. So if they were thinking that I was going to be the person who knew anything about oil and gas, I was the wrong person. But what I do know from my Glencore board position is there is a massive move going on globally towards renewables, and I know that Colette, who runs it, is really focused in that direction of moving us towards much more in renewable technology, these sort of things. So I think that's inevitably where we're going to see Aberdeen go, really, just to take advantage of that. It's fascinating on the Glencore board, where we're under huge pressure to spin off our coal assets. And I keep saying to people, that this shift to renewables is not just about a supply side issue. You can't just say, well, let's close down all the coal mines, because I don't know if you've seen recently, China are building even more coal-fired power stations now. So we've got to look at the demand side as well of the renewable space. So it's been it's fascinating, but really I just wanted to give something back to the city, and they don't even pay me either for that. So I'm having to do this. Actually, I forgot to ask if they paid me, and then I thought, better ask, in case they do pay me. I didn't think they did, and my worst fears were confirmed. It's something you do for nothing. But they're absolutely delighted to help the city in any small way I can.
Yeah, that's such a familiar conversation, very similar to the one I had with Jude McCorry, actually. But
yeah.
But yeah, I think there's quite a lot of interesting things going on with the people coming out of lockdown. If you could give just a couple of bits of advice for people who are emerging from hibernation for the last 3 months, what would those bits of advice be, Martin?
Gosh, I think the key is to really sort of try and get back to normality as soon as possible, and get back moving about, get your confidence back. Because I'm still shocked by the difference between the UK and Switzerland. I was in Germany earlier this week, and then in Switzerland. I'm still shocked by just how Switzerland has just moved on. So it's getting that confidence back, because I think the issue is for maybe good reason, we'll find out whether it was for a good reason or not when all these inquiries into this report, but we've certainly frightened the population. And that confidence is going to be really, really difficult to restore. It's going to be some time. And then just on the business front, I would say it's about surviving this year. It's just making sure you draw down, you just get as much credit as you can from the banks at the moment, because they're under really severe pressure to support business from the government. So if you've got a credible business plan, they'll be there supporting you, and then you've got to just look at all the grants you can get. But the key is just to survive. And sadly, for a lot of businesses, that's going to mean laying off people as well. So it's going to be a really, really tough time. But try and get your confidence back and moving around, I think, is the key, with obviously safety in mind.
Yeah, it's kind of really sage. I think when furlough starts to unwind in September, October, that's going to be a real testing time for a lot of businesses. I think they've had a kind of temporary abeyance of the real pain point. So I don't think we've seen the real pain point yet in terms of.
I think it's starting sooner than then. I think people will start laying off people now, because
yeah, you can see it. Yeah,
because I think people are beginning to realize that that when they have to start paying even more of the salaries, and that's going to bring the pain forward. Whereas at the moment, people are probably doing pretty well at 80% of their, if they're getting even 80% of their salary, they're not having to pay travel, they're not having to pay for expensive sandwiches in London, their mortgage rates come down. A lot of people are better off at the moment. And
yeah,
it was funny, in Switzerland, I was speaking to someone, he said it's like Sunday morning every day now. He said there's thousands of bicyclists out on the road. You know how on a Sunday morning everyone goes cycling? He said it's like that every day. And it's been great, I suppose, for a lot of people, but we just got to get back now before the economy really crashes.
Yeah, I kind of agree. My guess is a lot of people are going to come out of the lockdown a lot fitter, because everyone's been cycling and walking and running everywhere. As you're saying, in Switzerland, every day is a Sunday. Edinburgh's not quite like Switzerland, but there's a lot more people cycling about, walking about.
Every day it'll be,
Yeah. And what are the big opportunities post lockdown and post COVID? What, if you could pick 2 or 3 things, Martin, where will you put your money coming out of this?
I don't know. Equity markets, look, I think they're overvalued, but I've been saying that for many years. So useless at picking them. I think the opportunity is getting your business, doing the things that you maybe should have done, and this is forcing you guys. This is going to force you to do in your businesses. So really look at the cost basis of your business. Just get everything in shape, and then when the good times do return, you're gonna really do well. But it's just getting through to when normality returns, which will be what, 22, maybe a bit of 21. So certainly by 22, I would have thought earnings would be back to normal. So yeah, just getting your business into shape, and clearly some sectors are going to do really well. Anything in healthcare is going to have a bonanza. I think people are going to look more at local supply lines. They're just going to look at the supply lines, because I was speaking to one of the cabin crew on BA when I was flying down, and he said I said, what's your next trip? And he said, I'm flying to Istanbul tomorrow to collect personal protection equipment. So BA were flying a passenger jet to Istanbul, loading up. And I mean, it's ridiculous that we can't produce this stuff ourselves in the UK. So I think more and more of the local supply lines are going to really be improving. So hopefully local business will, in the food sector, these sort of things. Hopefully people will look more to where stuff came from, and buy more locally.
Yeah, I kind of tend to agree with that, and I think people's attitude to supply chain risk has changed completely in this process. And I don't think people want to get caught like that again.
No.
And people's view of risk and resilience and what risk means has changed completely as well. Nobody predicted COVID. Many people thought it might happen, but hardly anybody had it in their disaster recovery plans.
Yeah. Recessions tend to come out of left field, and this was no exception. Bear markets tend to come out of left field. So again, no.
Agreed.
it's going to be a pretty tough time ahead.
Jude, if we could just bring you in, how are we doing on questions in the background, Jude?
Yeah, we've a few of them here. So I've got one from Laura Presley. Martin, what advice do you have for companies coming out of lockdown? I think we've.
Yeah, no, as I say, I think it covered most of it. Just get your costs under control, and because I think you've got to plan for the worst and hope for the best. So I think just that planning for the worst and really, really making sure you survive through this, what's going to be a tough 18 months.
Yeah, I agree.
And this one has kind of been covered as well. So as the chairman of OGTC, what does Martin think about the impact of COVID on the energy industry in Scotland and priorities for the short and mid-term? And any observations about how he's seen investments shift and the industry react and adapt?
Yeah, I mean, I think COVID has had a huge effect. I mean, obviously the Saudi-Russia price war preempted the fall in the or caused the fall in the oil price, but now we're seeing demand being really, really low. And I mean, it's very, very difficult to find a tanker anywhere in the world because they're all being hired to store physical oil at the moment. So definitely that's going to have an effect. But as I said, a lot of investment now is going to shift towards the renewable sector. I actually think the price of oil and the price of coal are going to over the next few years are going to probably recover, because both those sectors we're seeing very, very little new investment in on the supply side, especially coal. We're seeing a lot of that falling. And interestingly, at the moment, because the Australians had what the Chinese think was the audacity to ask them to investigate the origins of COVID, they've stopped buying coal from Australia. So it does show how powerful the Chinese are. We should remember that China consumes half the world's commodities. So China's the hope for the world economy, and is actually doing its bit to recover. But it does control a lot of what. So it's choosing very much what it's going to buy from Australia at the moment. It'll only buy what it can't get from someone else at the moment. So coking coal, it won't buy any thermal coal. So it's the world is definitely going more towards renewables, but still I do see quite a big future for oil as well when the global economy does sort of pick up as it inevitably will.
Okay. David Miller's got one. It's probably for both of you, actually. So it'd be good to get both answers. And I probably know Paul's, but it has actually probably changed in the last few weeks as well. Any advice for early stage startups that can't access some of the government schemes for financial support because they are pre-revenue? We'll give Martin a break and go with Paul with this one.
Yeah, go on, Paul. I'll be interested in your reply.
Yeah, I guess the first thing is you need to. Actually, had a conversation yesterday with somebody along the same lines. A startup business that was focusing on blockchain and distributed ledger technology, and you've got any customers yet? And I said, well, the first thing you've got to do you need enough money to get you to a decent, minimally viable product of some kind and a proposition, and you need a customer. So don't sitting in an ivory tower trying to invent a new technology and then go to market when you invented it. You need customers involved in that engagement and that journey, because by the time you get to somebody like Part Equity, we're going to ask you, so who are your customers, and what is your revenue model and how does that work? and what is it that's going to differentiate from everybody else. And hardly anything in the world is new or completely new. And if it was, you'd wonder where the market was going to come from anyway. So I wouldn't focus too heavily on why you're absolutely unique, because you're probably not, and most people aren't unique. But what is it can differentiate, and how can you sustain that advantage, and where are the customers, and how much will they pay for this? And the guy I spoke to yesterday was really talking about maybe the airlines would buy my carbon trading exchange. I said, the airlines ain't buying anything in the next 2 years from anybody. So in the next 2 years, you need to pick a new customer. So you need to look, I guess that's the kind of follow the money. Where's the money going? Follow the smart money, and make sure that your proposition aligns with that. But you need to get to a stage to get decent VC money involved, that you've got something that you can point out with a product that works with some customers that are going to buy it.
Okay. Martin, do you have anything to add to that? Or
yeah, I think the issue we have, I mean, we have a massive issue in the UK in early stage, accessing early stage capital, which hence means that most of our businesses are severely undercapitalized, don't have the capital to get it to where they need to be. So it's it's interesting that again, Revolut, I'll use it as an example. 3-4 years ago, it raised money at a 5 million valuation. I'm losing my voice. Sorry, I'm going to get a glass of water. I'll leave Paul.
Yeah.
Yeah.
Just kind of add into that answer I gave. It's interesting looking at, I'm looking at some exemplary success stories. When Chris McCann launched what was at the time called Snap 40, now called Current Health, which we backed it with not much more than a literally minimal viable product. And when I put the emphasis on minimally at the time, and you know, he's gone from a business that had I can't recall the valuation, but it's of the order of $1 million pre-money, maybe $1.5 million. And the last money he raised, 3 years on, he raised at 50 million pre-money. So it's an example you can get from ground zero somewhere pretty meaningful quite quickly. But you know, going back to what Martin said, that in a Scottish climate, the two big gaps are there's not enough money for really early stage, as in, I mean, startup, absolute startup stuff, pre-revenue, pre-customer. There's not enough money around for that. And there's also not enough money in the kind of Series A, Series B. So once you get beyond, it's quite a lot of money, ironically, between $500,000 and $2.5 million. For let's call it kind of senior angel, early stage VC. But there's virtually nothing before that, and there's virtually nothing immediately after it, which is why we're planning to raise a scale-up fund.
The other thing we don't have, and it was funny, I was in Germany. We don't have these, whatever they call them in Germany, these middle strat companies, these big family unquoted. I mean, that is the bedrock of Germany is those businesses, and we just don't have those either. We just need more businesses. I mean, we need more people starting businesses. We need more people willing to invest in businesses. The money's there. To invest in exciting businesses. We just need to be doing it. And you know, we've got so much opportunity, not just in the fintech or the medical technology, but we have it in food. We've got it in all sorts of sectors. We could really, as a country, do really well.
I don't know what you think, Martin, but one of the issues is that the regulators are completely risk averse, which kind of means that anything that looks like it might be risky, like investing in an early stage healthcare technology business, looks like a no-no for retail investors completely. And certainly when we've been getting our EIS fund to market, until we got to the stage where we had decent analyst reports from the analysts that covered our sector, which is Alan Bridge, Martin Churchill, and one or two others, it was virtually impossible to get our EIS fund onto any kind of panel with a decent size wealth manager, IFA, advisor to retail investors. And so it really, it's only really the professional investors and the institutions who are going to back stuff. And it's very difficult to get access to institutional money for early stage investments because the check size is not big enough.
Well, I think the problem is if you try and get retail investors to invest, you got to remember that if it goes wrong, they expect to be compensated. So my strong view is stick with professionals, stick with the institutions, because at least they understand the risk, whereas retail investors are susceptible to poor advice, and that's why you get a wealth manager. Wealth managers are also pretty risk averse, but they have a function. The other thing we got to remember is the world's wealthy don't need to make any more money. They just need to keep what they, because they have made so much money in the over the last 10 years, just because of the very low interest rates, and so all their assets have tended to go up in value. So so there's a huge market in the wealth industry for wealth preservation rather than wealth creation. So it's so gotta look at that. But there again, a lot of people do want to get into the field of unquoteds, and these guys in Revolut who put money in at the 5 million round. One of them couldn't allocate $500,000 internally to their own fund and gave it to two individuals, and both of them made 80 million. So there are spectacular amounts of money to be made if you get the right companies like the Revoluts of this world, and avoid the wire cards of this world, which
we bought into a company at ICS Learn a few years ago, and our investors made 100 times their money back.
Yeah, it's great.
We have a question from Jeffrey Steiner, who's joined us from Canada. And he said, can government, probably goes back to the reports this week that were launched in Scotland, can government match in some way investment by angels?
It's difficult. It's difficult. I think especially it's going to be more difficult going forward just because of the finances are going to be under extreme pressure over the next 2 years. The thing that's bailing governments out is their cost of borrowing is so low. I mean, it's all negative interest rates everywhere in the world. So certainly governments can afford the borrowing. There are people prepared to lend governments money because the pension funds want to match their liabilities by lending money to the US government. So that's good. Whether they'll match investments, they probably wouldn't see that as part of their remit. But again, they've been really great with the oil and gas technology, OGTC, because that money is all from government and being used to fund research and rather than take big equity stakes.
Yeah, I mean, this is specific to Scotland, but the Scottish Investment Bank, of which PAR is one of the partners, does actually match fund the stuff we do to invest in equity in Scotland. So, and they'll match up to 50% of the deal. We've also recently been allocated 15 million from British Business Investments, part of British Business Bank, to match investments we make in the north and Scotland primarily, which is our kind of main operating domain. I'm not sure the same kind of mechanisms exist in other countries in the same way. I think 1 or 2 countries have things like this, but very few countries have something like the Enterprise Investment Scheme, which we have in the UK, which means that in the UK, if you invest in early stage technology companies, you get pretty hefty tax relief on the way in. And if it wins, you pay no capital gains tax.
I think that's the key, isn't it? The tax breaks are great.
Yeah, they are, for sure. And the biggest worry I would have is that the government somehow decides to take those tax breaks away from early stage investment. That would be pretty disastrous, and hopefully they don't. But yeah, I mean, EIS investments, tax breaks in the UK are a significant boon for early stage investment.
Okay.
Anything else, Jude?
No, and I think we should probably put in a plug for the mentoring scheme that we launched at SBRC.
Yeah, absolutely.
So anybody who is looking at issues around COVID, or also looking for advice or some very, very high level mentoring for the business, they can apply on the SBRC website. If you just Google free mentoring with SBRC, it'll come up with the application. And it closes tomorrow. So we've had some really good companies in who aren't afraid to look for help and also advice, and spend this time and take this opportunity that's come out, that's funded by Scottish Government, and with very, very high level mentoring. Do you want to say anything else about that, Paul? So
yeah, it was a fantastic initiative, and we're kind of hopeful it's going to be the first tranche is going to be really successful, and if it is, we hope to be able to get support and help to a lot more companies. And that was the ambition for Scottish Business Cares. We've provided webinars to 3,500 companies so far, huge since we started. Which I know is only a small percentage of Scotland's companies, but it's 3,500 more than most. So we're quite pleased with that, I think. But the more companies we can help, the better. And as Martin said, I think the next 12 months is going to be pretty tough for everybody. So the more help we can get, the better, I think. That's all I'd really like to say. But yeah, I mean, everyone should apply. I think somebody was asking a question earlier on that was an absolute startup. Apply. Yeah. We've not restricted who should apply. It can be anything from somebody with a business idea through to a pretty well-established business. We've only got
some people have started up in the last few months, and they planned to start up. They didn't plan for COVID to hit. So any support that any of these mentors and stuff can give you, just even if you wanted to have a chat with me, because I think people are afraid to apply, thinking that it might not be applicable. But I would take any help and resource at the moment for any of the decisions or help you need or support going forward.
Yeah, we absolutely need to be able to support our early stage high growth companies, because without that, we don't end up with companies like Aberdeen Asset Management. Aberdeen Asset Management was a startup back in the day when Martin started it, and that's probably a good place to finish. Martin, many thanks for your insights this afternoon. Fantastic success story, lots of great lessons for people who've been on the call, and looking forward to dragging you onto another SBC call in the future, and maybe get you involved in part equity as well along with you. Who knows? Listen, thanks everyone for coming on to the call this afternoon. It's been a great experience from my standpoint. I'm sure from Jude and Martin. Thanks for coming on, and we'll see you at the next one, which is like in a couple of weeks' time.
Yeah, thank you very much. Thank you.
Thanks, Jude.